You want to make consistent income without risking too much of your capital. You look at SCHD, but you see it was trading downwards towards the end of the year and doesn't even pay a 4% dividend. You look at QYLD and see your capital dwindle away if you're not reinvesting it. And don't even get me started on Tesla, which would have scored you a nasty loss on your capital if you didn't reinvest any of it. Let me show you a way you can keep your capital and make a consistent income using options right here. As usual, none of this is financial advice. I am not a financial advisor.
Knowledge.
Now, one of the first questions we should define is what would be consistent income? Is making 0.5% per month consistent enough? Conservatively, should we shoot for 1% per month? In this video, I'm going to show you how to do 1% per month for consistent income. So if you had a $500,000 portfolio, you're going to be making over $50,000 per year. You're going to be making $60K because you're going to be getting percent per month, which is $5,000 per month with a $500,000 portfolio. So how do we have our initial capital and not worry about it dwindling away, but still able to use this capital to make income? So on the screen, I have SPY, and let me show you some math how we can do this. The current trading day is 11/7/2023, and we're going to go to SPY options. Now, if we want something simple for income, let's choose a monthly because it's not something we're going to have to actively manage that much. It's something we can just sell and be done with. We don't want to be rolling our options too often on like a weekly or even smaller than a weekly. So let's choose a monthly so it's easy because we want something simple. We're not managing that much. So let's go on our options chain and let's say we'll expire about 31 days away. That'd be about a monthly. And we're going to have two ways to do this. One is very simple, is we're going to sell a put and try to collect 1% of the capital we're putting up. So you can see we have the strike price over here, and all we have to do is scroll down and select a put that's close to the strike price to collect 1%. So this strike price, if we selected $432, we'd be saying we'd put up $43,200 because each strike price is times 100, and we would collect $4.29 per share. But since this contract is 100 shares, we collect $429. And it's very simple. What is 1% of $43,200? Remember, this is times 100. What's 1% of that? $432. And that's very close enough. So we could sell a put with a 72% chance of in the profit and below the current strike price and collect that money. Remember, that money you're going to get is cash. So that way you already made a percent gain on the month and you have some downside protection. If the price blows through and you get a sign, you can sell a call at your break-even price and try to collect a percent, but it might not always work out like that. Now, this strategy would make more sense if your brokerage pays you a fixed percentage, even when you sell puts. Supposedly, Robinhood does not pay you cash while you're selling puts. Now, Fidelity still pays you an APY when you're selling puts. So this would actually be more than 1%. But if you're trading on Robinhood, consider Fidelity, or you can do something with an in-the-money covered call. So if our current share price is $436.45 with the in-the-money covered call, we're going to have to buy 100 shares. So let's assume we bought it at the current price, 0.43. And this is times 100, but we're just going to do per share for now. And let's scroll down and see where we can collect about a percent, and I'll explain the math as we go along. So 422 looks like a decent price right here. So if I agree to sell the stock back, this is what I bought it for, and we're going to sell it back for $422 per share. We are currently taking loss per share of $14.43. But if we collect all this premium, if we collect $18, and it said 88 cents, let's do that, per share, we're going to offset this loss. So let's see how much we'd make with this additional premium, because we're collecting all this premium for agreeing to sell this call at $422. So this is what we bought it for. This is what we're selling the stock, incurring this loss of $14.43, and this is our premium. So we have negative $14.43 plus $18.88. So per share, we're going to collect $4.45 with the in-the-money covered call. But remember, this is times 100. So we're really making $445 for this in-the-money covered call. And you see this $445 is over our initial capital we put up, which per share was $436.43, but over times 100 is $43,643. So with the in-the-money covered call, we get downside protection to $422, which we agreed to sell the share price. Go away. and then we're collecting a percent very easily. And this would be good if your brokerage does not pay you percentages for the cash hold while selling puts. So very easy to collect 1% within the money covered calls. And how much can SPY drop and then you still don't have to worry about anything? 422 divided by 436.61 minus 1. SPY can drop about 3.3% and then you're still good, which is truly incredible. Now, if you don't want to worry about monthlies and you're like, I want to make one trade a year and then that's it. I want to be done and not have to worry too much about my capital. Let's go all the way to about a year out. So we got 328 days, which is close to a year. I think there's something really simple we could do, which not a lot of people do. If you want to collect an easy percentage per year on your money, you could just sell a call right at the money, because you have the share price $436 and you can collect $35 per share, so $3,500 or $3,400.88. And you could sell a strike at the money, and then you're collecting a lot of premium with literally work once a year, just buying the stocks, holding them, selling a call at the strike price, and then you'll also get the dividend from SPY because you sold, because you own the shares. Now, this wouldn't exactly be a percent per month, but let's say we bought it for $436 and then we collected $35 per share. 35.53 divided by 436.33. We would still make an 8% gain on the year for buying shares and then holding them and then just selling a call a year away from now. And this would actually be more because we collect the SPY dividend. And that'd be nothing. It'd be super simple. Once a year, you just do this. And then a SPY drops. Hopefully the call you made would cover you on the way down. You could roll it, but if you're just hoping to sell something once and be done, this isn't a bad strategy because it'd cover you about 8% down if SPY drops. Now, you may be wondering, what about COVID? What about flash crashes? What about, stock market corrections? Nothing's really going to protect you guys unless you're actively managing your positions. SCHD has fallen, QYLD has fallen, Tesla has fallen. All of these things has fallen as markets fall. You have to actively manage your portfolios if you want to avoid these drawdowns. There's no perfect strategy, but this one is for someone who just wants income without having to actively manage many things. Overall, I think these strategies are really awesome, really simple. And then you don't even need to make a percent per month. Maybe you can make like 0.5% per month on your portfolio and be chilling. But if you need something to easily track your options trades, if you are selling options, check out my wheel trading spreadsheet right here. Peace.